Welcome to the September update for the Hopkins Group Managed Discretionary Account Portfolio. My name's Mark Wenzel. I'm the head of the investment committee here at the Hopkins Group. We had another robust meeting last week discussing the current economic environment, any potential changes to the portfolio and where we think markets are heading and how we can position the portfolio to capture the future growth. To start with the economics outlook, generally the macroeconomic environment, both here and globally, is pretty strong. Despite all the interest rate rises, economics continue to point that there's growth in the system, that economies are strong and that employment remains pretty robust across the globe. The big issue, I guess, with the economic environment is inflation's remaining sticky. And if inflation remains sticky, we're going to have potential for further interest rate rises in the future, which again will dampen economic growth. The key question, I guess, that the markets are posing is what's happened so far and how much of an impact of the interest rate rises so far having, and how much of the savings that were built up during COVID are being drawn down to fund the current lifestyle. So they're the main things. In Australia, we've had some pretty good unemployment figures still. Employment remains strong. Particularly, there's some real growth in part-time employment, which indicates that, again, that there's some jobs out there, particularly in the services sector, which is starting to see come through. And that's also impacting, the outlook for inflation as well, with service charges starting to pick up because of the higher inflation costs. There is some signs of stress within disposable income. So we're starting to see, growth in Australia, I guess, forecast to be sort of that 1.6%, which is really below trend. But given the massive rise in interest rates, we're still seeing some positive, some growth and sort of expect that continued growth going forward. China's been a big impact on Australia, and we've seen that play out in a number of ways. We've seen falls in iron ore prices and some commodity prices because of the growth in China is not as strong as it has been in the past. And with that, it's particularly construction sort of in China is falling off a cliff, and that's sort of really potentially problematic going forward. But you're starting to see a little bit of stimulus come through from the Chinese government, and probably a bit of targeted stimulus. So we're hopeful that over time that's going to provide the support that's needed for the economy. And even despite all of that, forecast again for GDP growth around 4% in China is pretty strong, given the size of the economy and the impact that it has on the global economy. So the other sort of points to make, I guess, is that we sort of now starting to see that interest rates are going to stay higher for longer, which means that some interest rate cuts next year are probably not going to come through. Maybe it's in 2025, but it's really dependent on how well the Reserve Bank can get inflation under control. We are looking from a portfolio perspective. We didn't make any changes to the portfolio this month. We've decided, despite some back and forth about where the markets are heading, that the positioning that we have is appropriate and remains appropriate. So particularly, we've got some good exposure to growth if the markets do kick on, and that perhaps that inflation starts to come under control, and that the market's starting to feel confident that interest rates are going to peak and that they're going to start to come down in the future. So we've still got some really good exposure to both growth and value style equities. We've also got some protection there through infrastructure and also through private equity, which again has sort of been a pretty solid sort of performer in the background. We've got not a huge exposure to small companies, but would look to increase those when the market sort of turns and when things are starting to look better. And then, from an emerging markets point of view, we don't have a lot of exposure to emerging markets. We've got a little bit there, but most of the money is focused in developed markets and the large cap markets in developed markets. With regards to bonds, again, that was sort of really where the robust conversations really were had, whether we should start moving to fixed rate bonds or maintain the exposure to floating. we decided to maintain the floating rate exposures just in case that sort of inflation starts to or increases again further, and that interest rate rises are going to start to come through if that's the case. So we wanted to maintain that exposure to floating rate notes, which has provided some really good outperformance for the portfolio, just because we've been getting the high income without sort of losing capital as interest rates have increased. With the sort of the outlook on the future, we as I say haven't made any changes, and we certainly don't think we're making any changes at this stage. One of the key features, I guess, of the portfolio is that the portfolio's been unhedged largely. So we've got 30% hedging in the portfolio, which means that the Australian dollar's been falling. And that's benefited the portfolio going forward. So we're keeping a close monitor on that, and with the potential to increase hedging as the dollar gets towards 60 cents or below. But again, at this stage, we're comfortable with maintaining the hedging at 30%. So generally, the portfolio performance has been very good. We're certainly comfortable with the way it's positioned, and then certainly outperforming its benchmarks. So thank you for taking the time to watch the video this month, and look forward to presenting another video for you next month.